Well, thanks for tuning into this broadcast from BloombergQuint. We normally do an earnings preview with the think tank at Citi. This time around, we are doing it a couple of months late, and we're doing a review simply because it would have been foolhardy to try and preempt what the quarter, as difficult as quarter one, would have thrown up. And I'm guessing it's probably not as easy to talk about the quarter gone by as well, because the trends are changing ever so quickly, week after week, month after month. But let's put the men in the difficult spot, the men who are joining me in the difficult spot, as opposed to me trying to do that. Surendra Goyal, Prashant Nair, Aditya Mathur, and Manish Shukla from the Citi team join in right now to talk about their assessment of the quarter gone by and the trends that they are seeing in the subsequent 2 months post the end of quarter one as well. Gentlemen, all of you, thanks so much for joining in. And I'm guessing all of you are safe, so happy for that as well. Surendra, can I start off this conversation with you? What did you make of the quarter and the subsequent 2 months? Have things changed materially for the listed space?
Sure. Thanks, Neeraj. Thanks for having us here. See, from a quarter perspective, as you rightly pointed out, that this was a quarter where it was very difficult to forecast. And secondly, it doesn't really have too much of future-looking or recurring value, because it was a unique quarter with all the disruption and lockdowns. So I would kind of highlight maybe 2 or 3 points here. Firstly, if you look at the BSE 100 companies, the operating profits or EBITDA actually came in better than expected. Okay, so at least till last week, around 85 to 90 companies out of 100 had reported. And earnings or EBITDA was only down 8% or 9% YOY, so high single digit YOY, which I think in the context of the GDP number, etc., which came out yesterday, you can clearly see that corporates have really been able to take costs down, bring costs down quite meaningfully. So that, I think, to me was the biggest highlight of the quarter, where companies delivered significant cost savings. And because of that, the reported numbers almost across sectors came either in line or slightly above expectations. So that's the first point. Now, secondly, I think just focusing on the headline earnings may not be right, because all this cost cutting which corporates are doing might have an impact down the line. So just to give you an example, the employee costs for these companies which have reported, last year, same quarter, they were up 12% year over year. This year, they are up 2% YOY, right? And that does have an impact on consumption as we go forward. So I think looking at the cost cutting in isolation may not be right. So I would kind of leave you with those 2 points. One is, yes, corporates did deliver on costs. They did well. Revenue, we all knew there was going to be a significant impact. So revenues were down 18-19% YOY, which was very much in line with our expectations.
So then the part two of the question is, it was, as you said, a known fact that quarter one would be a washout in that sense, and maybe some companies actually surprised positively. The question is, will we see an extension of that, which is digestible in quarter two? So quarter two arguably will have higher economic activity than quarter one for sure. My point being, what spaces or what spheres in terms of the delivery and the commentary make you believe that quarter two, quarter three, quarter four might be further extensions of the good show shown in quarter one, or could fall apart even though they may have shown some traction in quarter one, say?
Yeah, so I think it's a difficult situation even for corporates to forecast, right? You may be forecasting with a particular assumption, and then suddenly you figure out there is lockdown in 5 states and all those assumptions change. So it's a volatile situation, and because of which corporates generally, while they have sounded a bit more optimistic, they have been guarded, because everybody will caveat it saying that we are watching the situation very carefully or closely. So I think that's the kind of situation we are in. Having said that, it does look like gradually things are only opening up. And to that extent, as you rightly pointed out, economic activity is picking up. On the cost side, while Q1, there was like a significant reduction, some of those costs will come back. But in my view, I think corporates will try to bring their cost structures down. They will use this opportunity to bring their cost structures down. So margin trajectory may be a little better than what we would have expected in January, February pre-pandemic. So I think we are definitely looking for a recovery as we go forward. I think the bigger question is, will that be enough given the way the market has played out? So I think that to me is a bigger question. I think directionally we should only improve as we go forward.
Okay, well, TMT, FMCG, pharma stood out. Maybe specialty chemicals stood out. Banking, mixed bag. FMCG, mixed bag. Surendra, before I get to Prashant, Aditya, and Manish for their respective themes, so leave those sectors which they are specialists of out. Anything else? And we'll come to IT as well, Surendra, with you individually. But I think anything else within your coverage universe which stood out for you and the team at large?
See, if you are focusing on it from a quarterly perspective, I would
Or the
say,
commentary perspective.
yeah, it almost all the sectors did in line or better on costs, almost all of them.
Sure.
So if you look at consumer discretionary on the operating profit line, there is a significantly better performance, right? Similarly, in cement, there was almost a surprise across the board as far as costs were concerned. So I think on the cost side, all the sectors either did in line or better. But I think in terms of the outlook, the dependencies are the same. The activity levels have to pick up for things to improve for any sector going forward. Again, the only difference I think is exports versus domestics. So obviously those are very different end markets. So that trend could be different. But otherwise, I think all of us are watching out for the same thing, activity levels picking up.
Okay. Well, let me go in the order of the gentlemen which are appearing on the screen. Prashant, let me come to you first. And since Surendra brought out the point about exports as well, the space that you track so closely was probably the darling of the markets. And in some sense, some of the companies participated by displaying good numbers as well. What stood out? What didn't?
Okay, so yeah, so pharma results were good, better than what we had expected. Two things particularly drove the beat. One, as Surendra mentioned, cost control or cost reduction was very clearly visible and higher than what we had anticipated. This primarily came from the Indian market where doctor visits, promotions, all promotional activities were on hold. There were no doctor visits. So clearly, companies just felt the need to let the bigger brands run and not do too much of a push during this quarter. So that has reduced costs significantly. The other thing which stood out across the companies we covered was API sales. API sales growth was much, much higher than we have seen in the past. This is a bit difficult to exactly figure out what drove it. If talking to companies, what it seems like is that it is partly driven by their customers wanting to keep additional inventory now in the fear of a second wave and maybe there's another disruption in supply. But this could also be to some extent companies looking for alternate sources from China, cultivating second sources. So it could be a mix of both. And as we move through the rest of the year, we'll get a sense of how much is sustainable and how much was just restocking. So these were the two things that really stood out. The points where there were weaknesses where, say, US revenues were weak across the board. That was a function of significant stocking up in the fourth quarter ahead of the lockdowns out there. So clearly that tailed off. India revenues were weak as expected, but these were offset by the first two factors that I mentioned.
So what looks like continuing? I mean, the API commentary from most companies that we spoke to post numbers and actually 2-3 weeks after the numbers still seem to be robust enough. So do you reckon that theme might continue to play out? And just a question on US revenues as well. Companies which have come out with some releases in the last 2-3 weeks seem to be showing a tinge of optimism. I don't know if you've read into it the same way. What are your conversations suggesting?
Okay. So on the API side, so we need to split these into pure API companies and companies like the sector leaders who also do API. So for the sector leaders, the APIs are primarily a backward integration requirement, and then whatever is excess capacity they sell. So while demand may continue, whether they are willing to actually put more capacity up in order to continue to grow this business is something which will differ across companies.
Sure.
So, for example, a company like Dr. Reddy's or a company like Aurobindo, for whom APIs is as core a business as a formulation side, may probably continue investing behind this opportunity. Some others may not necessarily do so. For pure API companies, we think there is an opportunity because there is this avenue now where you can position yourself as an alternate supplier. The government is providing some incentives. Near term, it's a bit more difficult to call. Near term, if there's a lot of stocking up that has happened, then you may see some softness. So as I said, it's still not very easy, and companies are also not, companies are, as I said, quite guarded at this stage, because even they are not very sure how things will pan out. Your second question was on the US. So I think the releases you're referring to are more on individual product approvals, if I'm not mistaken. So those will continue. I think product approvals have been continuing right through the pandemic. So the FDA, I think, has done a good job in trying to keep at least the day-to-day approval and review process on course. The only thing that seems to have hit a roadblock is resolution of compliance issues at facilities where there's either a warning letter or there are some corrective actions that need to be evaluated. So approvals are continuing. We don't see any significant change in trend there vis-a-vis what it was pre-pandemic. Depending on which company you look at, if there's a good approval, they will have a good set of quarters because those products will contribute. If there are no meaningful approvals, then we'll see the current trend continue.
Okay, we'll talk about some of these pure play API drugs and the broader healthcare space as well in a bit. Let me try and shift focus to the other bucket, which is staples and FMCG. And Aditya, no surprises that the space saw frenzied buying, etc. I'm just wondering if you reckon that some of these themes could be here to stay, and which of these companies you thought emerged winners according to you, based on your estimates, based on the commentary that they gave, based on the finer points that you may have seen in their interactions?
Sure, Neeraj. I mean, it's staples, while at the headline level has obviously done pretty well. I think it's been a bit of a mixed bag if you look at different names, particularly on the top line front. If you ask me, I think anything that's got to do with health, hygiene, maybe home care products have disproportionately done pretty well. And I think I'll definitely call out the packaged food space, which has definitely seen a surge. So I think these categories, which are considered to be less discretionary, arguably, there is higher consumption as we're probably working from home, or I think will tend to continue given the situation that we are in. And I think that's a trend which will sustain. I think it's a slightly more discretionary segments, or segments which have more got to do with out of home consumption, which have been impacted. And honestly, I think they will remain subdued even in the foreseeable future. May not be as bad as they were in 1Q, but we don't expect anything great coming up there. To my mind, names like Hindustan Unilever, Britannia clearly stood out, where the numbers were definitely better than what we were forecasting. I mean, like we've discussed earlier in the show, that I think forecasting was always a little bit of a challenge this quarter. But I think we have sort of maybe we were just super pessimistic in August when things basically came to a standstill. And I think these companies have also sort of shown some resilience in kind of coming back in, and clearly demand side of the more staple part of the portfolio have sort of held up.
Okay, I won't get into cost because that's probably a common factor across companies. But a two-part question. One, if you thought that this whole theme of staple or FMCG companies diversifying into a number of products is something that could become a meaningfully larger trend for them, or is this trying to cushion the blow? I'm asking this to companies, but none of them is forthcoming about that. And part two of my question would be, if you believe that there is a really meaningful how do I say, a product category creation that has happened, which some of the listed names have been able to tap into?
I mean, I think if you ask me, people are being a little tactical out here as well. I mean, there's clearly an opportunity out there, things like hand sanitizers, personal wash. There is an opportunity. Clearly, you just have to put the product out there, and companies which have large distribution networks, I mean, clearly will tend to benefit out there. So I think there has been a little bit of a tactical move out there, which I don't think is necessarily bad. I think, if companies have been agile enough and nimble enough to kind of tap into those opportunities, I would actually read that as quite a positive. But I think, there are companies like Dabur's healthcare portfolio, or maybe, the Unilever's, the overall health hygiene category, I think there is room for them to grow into categories which I think will become a lot more relevant today. I mean, than they were even 6 months ago. And I think that's a trend which is here to stay. If you ask me, I think I don't necessarily read that very, very negatively out there. I mean, clearly hand sanitizer sales have gone up like 50, 60 times. Probably will come down or normalize, but I think it'll clearly the consumption will be higher than what it used to be. It was a niche category even for the uber rich in India, and I think it's now very, very mainstream, and that's something which is here to stay out there. And I think the same thing I can say about a lot of packaged food segments as well.
Yeah, I reckon all of us, once we get back to our offices, will have extended use of hand sanitizer, even though we don't like to use them. Just a very quick follow-up before I get to Manish, Aditya, and that is this whole question mark around down trading. Like we've seen a number of your peers said, for example, downgrade stocks, believing that some of the products in the paints category, for example, or somebody spoke about Marico's value-added hair oil segment seeing probably down trading, and therefore the lower price points getting some uptakes. Would you reckon that down trading is a clear and present danger, or not quite?
I don't think so. I mean, I think the jury is still out. I don't think we can say it either way, but I think I would also argue that there have been a lot of these companies which have been pretty smart about the fact where the supply was under, severe pressure. I mean, there were constraints around supply, and they've actually moved a lot of their supply and manufacturing and sales to the higher margin or the higher, the slightly bigger products out there. So I don't really think that down trading is that much of a common theme as we would have probably feared in the initial days of the lockdown out there. And I would argue that as the supply side is now ironed out, um, I mean, I think there are some green shoots that we are seeing in some of the more premium segments as well. So I don't think I would read too much into it. It's still early days for anyone to take a call on this. But I mean, I would not be in that camp who thinks that down trading is something. And in a lot of cases, you have seen people shift into the same brand but maybe smaller size SKUs there. Which I think is again, companies which have been agile enough to kind of, get the supply lines up and running. I think that they are definitely tending to benefit out there. But I don't see down trading as a common theme. There will be segments where it's more relevant, but
got it. Okay, fair call. Manish, the big conundrum for financials, right? 2 or 3 things, or actually multiple things, not just 2 or 3. Where are you on how the display was and how the post-moratorium world would look like? Though I see a number of reports talking about some appeals for extension of this as well.
Sure. Thanks, Neeraj. So I wish it were only 2 or 3 things. So quarter gone by, obviously there were far too many moving parts, but a single number which most of us were focusing was on moratorium. And moratorium numbers did come off quite substantially, given that economy had opened up in the month of June. Right now, while there is some talk, as you rightly said, for extension of moratorium, the reality is that with the monetary policy review in August, RBI did announce a lot of measures. And now effectively you have a kind of blanket restructuring option available to the banks. So banks will take that call on a case-by-case basis rather than RBI being prescriptive about it in terms of whether it should be another 3 months or 2 months or 6 months, right? And this time around, RBI has allowed banks to restructure both retail as well as wholesale loans in addition to the SME scheme, which was already there. So to that extent, I'm not sure if there is any case for a blanket moratorium extension, but we need to wait and see how long it takes for banks to implement the restructuring package. Because in the absence of restructuring, we may not have much clarity on asset quality. So while we can discuss about the quarter gone by, the challenge really for us is forecasting the NP and credit cost for this financial year. Because pre-moratorium, pre-restructuring world, we were kind of assuming that of the morat book, certain portion will become an NPA for most banks, right? Now it's not going to be as straightforward as that. And it will be, some banks might be, let's say, more conservative and show higher NPA and lower restructuring. Others might choose to do it differently. So I think that is what complicates asset quality outlook for the rest of the year. On the operating profit, I think trends for the quarter gone by were more or less in line with expectation. Loan growth was soft as expected. Margins were under pressure given the excess liquidity which is there on the balance sheet for banks. And those trends might persist for a quarter or 2. But yeah, I think asset quality is where there are still some unknowns, if I may say so.
So, because these are unknowns and difficult to predict, I won't ask you to even comment on that. I'm trying to make this simple, Manish. The common consensus call seems to be more so in banks, the K word, the K recovery curve, and the stronger ones getting stronger now, or the ones which are able to raise capital. Now, there'll be some that you'll be able to comment on, some you won't be. But almost everybody is bucketing the HDFC, Kotaks, maybe ICICI, Axis, etc. in one, and the others in the other. Are you in that same camp, or do you think slightly differently? And for which
Sure.
ones?
Sure. So, I mean, capital, interestingly, over the last 2 months, the quantum of capital raise which has happened is probably one of the sharpest that we've seen in such a short period of time. And we've seen banks and NBFCs across sizes raise capital. So capital cushion generally for most of the larger banks and NBFCs, or even many of the mid-sized banks, is quite comfortable. The question really boils down to is liabilities. How well or how often can you really raise cost of deposits and funding, and what is the cost of that money? Which is where some bit of polarization is playing out, which is what you also hinted at, that the larger entities seem to be getting the bigger benefit, be it on the banking side or the NBFC side. So, for example, banks' deposit flow at some of the larger banks is strong, despite them offering lower deposit rates. Same thing we are seeing in the NBFC funding costs. For example, one big difference between June and now is that the corporate bond spreads have come off quite substantially. I mean, April and May risk aversion was very high, and spreads for even AAA entities over GSEC was higher in the month of June. But July, August, that spreads have come out. So funding costs are generally trending down, but availability of funds is not high enough. So if you're taking, let's say, thinking about growth coming back sometime in December or March quarter, these larger entities would probably take the bigger market share because capital is available for all, but liabilities is with the larger entities.
Interesting. We've had one of the largest ones also see a management shift, etc. Too. Any thoughts on that, and any thoughts on the PSU lenders at all? I mean, I don't know what forms a part of your coverage, Manish, but any thoughts?
Sure. I mean, yeah, I mean, in case of HDFC Bank, we've had a CEO change, but Mr. Jagdishan has been with the bank for a very long time. And to that extent, we expect this change to be quite smooth. And the bank is a very well-oiled machinery in terms of systems and processes. And we've seen that time and time again. Over the last 6-7 years, the bank has seen some management exits, and that's really not impacted the operations. So to that extent, at HDFC Bank, we think the transition is going to be quite smooth and should not be as big a disruptor. On public sector banks, we do cover some of them. The challenge really for them is that capital is still constrained. So we've not seen many public sector banks raise capital. And many of them do have exposure to SMEs. SMEs is a reasonably large component for them. Now, you could argue that there is a restructuring scheme available and there is government guarantee scheme which supports the SME. But at the margin, it might make the balance sheet a bit opaque. The difference with private sector banks, though, is that the core operating profit at private sector banks, when I say core, I'm excluding treasury for the moment, is pretty strong for private sector banks, which allows them the cushion to make provisions if required. For public sector banks, the core operating profit is still weak because they didn't necessarily have too much of fee income and cost ratios are on the higher side. Though what will work for PSU banks more than government banks or more than private banks is the treasury gains, right? I mean, first quarter, we saw very decent treasury gains. Towards the second half of August, bond yields were going up, but yesterday's RBI's announcements clearly mean that bond yields are likely to remain comfortable for some time. So the treasury gains or the GSEC book can act as counter-cyclical from a P&L perspective. Whether that necessarily reflects in terms of stock multiples, we'll have to really wait and see.
Okay. And thanks for that, Manish. Surendra, if I can come back to you, one of the things that most people are actually talking about is that the world might actually have a better recovery than India simply because of the number of rising cases. Be that as it may, because we don't know whether that will turn out to be true or not. My question to you, therefore, would be: what about the export-oriented themes? Prashant spoke about pharma, but what about the others? Do you have thoughts on metals and specialty chemicals, for example? And then, of course, I would love to hear from you about what you thought of information technology as well.
Okay, so maybe let me start with IT services first.
Sure.
So I think the trends that we have seen there, firstly, there are certain large verticals or industries where the sector has held up very well. be it technology, be it financial services, be it large part of telecom. And these are all large verticals. And what has been impacted very significantly is sectors like travel, hospitality, to some extent, some parts of retail, but those are relatively smaller exposures. And that is why the sector came out better. And as we go forward, our view is that things will only look better with sequential growth coming in the September quarter itself. Okay, and progressively things get better, and next year should be even better because there should be some amount of pent-up spends which come in. So IT services from an outlook perspective is looking quite decent. On the other export sectors as well, I would broadly say, metals is, I would kind of talk about it separately. But in a lot of other sectors, we are seeing that demand trends are pretty okay. Okay, and there was some bit of supply chain disruption, etc., which happened, and those things are also normalizing. So as a category, I would say exports are kind of holding up relatively well at this point of time, at least from a listed space perspective. Now, so I think on exports, I would kind of leave it there. On metals, I think it's a much more difficult call because I think a large part of it has to do with the dollar view, where we have seen a significant dollar move. Dollar has depreciated a lot. So it's almost depreciated, say 8% over the last couple of months.
Yeah.
So that always helps commodities and metals. It also helps emerging markets. So I think those are two trends which have played out in parallel. Now that I think is a difficult call because one has to be very convinced about the dollar depreciating a lot more for that trade to work out. So I think metals is a more difficult view to take at this point. At this point, we have a small underweight position. Again, we have a bias towards steel, but that's where we are.
Okay. The last round of questions to each of you, and because we are kind of now very close to the finish line, so to say. Surendra, I'll start off with you. A combination of where you thought the commentary within your coverage universe or within the entire space, a combination of where you thought the commentary was positive and where you anyways had a positive bias. Anything within your coverage universe or otherwise?
So, okay, see, I would say from a coverage universe perspective, IT services, we had a positive bias, and that sector clearly surprised people with the commentary kind of talking about a recovery in the second quarter itself or the September quarter itself. Initially, I remember having a lot of client conversations in April, May, where people thought it would take 3 quarters for demand to come back. So that's one sector. Pharma, Prashant already spoke about it. I think clearly things held up better. Okay, and it has surprised. On the consumer discretionary side, particularly autos, I think again things seem to be coming back. So I would say there are quite a few sectors where things held up better. Companies are, as I said, while they are optimistic but a bit guarded in terms of the quarterly trajectory, and again, understandably so. I think the key remains how activity levels normalize, because we already saw some bit of plateauing as we went into August and July. So I think that remains the key. That is something to watch out for as we go forward.
Okay. Thanks for that, Surendra. Prashant, within the stuff that you look at, a combination of where you thought the commentary was better or as per what you estimated, and you anyways had a positive bias. I'm just trying to understand where is it that you have a positive bias on?
Okay, so pharma is very stock specific. So for example, 3 companies which stood out where, so what we were looking for is outside of cost reduction, was there any momentum in the business itself? So 3 companies which stood out, 2 of them, Dr. Reddy's and Aurobindo, we have had a positive view on, and they both beat not only on the cost side, but on the revenue side as well. Dr. Reddy's primarily came from the API side, and Aurobindo actually held up much better in Europe and US than most of their peers. The third company which surprised positively over and above cost was Cipla, where we actually were negative going into the quarter, but we upgraded post the quarter because the business momentum was a lot stronger than we expected. What worked in their favor was that the India business, particularly the unbranded generics business, really got a big boost given that people were not going to doctors. So they were relying on pharmacists to recommend medicines to them. So the unbranded generics part really did very well. Cost reduction was strong across the board. Outside of pharma, labs held up much better than hospitals on the health services side. Diagnostic services, there was meaningful recovery in June, and that helped the quarter, do much better than what we had expected. Hospitals is still sluggish. People still seem to be reluctant to visit hospitals. So even the quarter was not great, and even post the quarter, it's been relatively sluggish. You haven't seen significant recovery. There is some pickup because of pent-up demand for surgeries, but that's a space where the recovery is still to be fully visible.
Got it. Thanks for that, Prashant. Aditya, again, same question. I mean, what stood out, and where is it? Not just for the quarter, but even in the ensuing 2 months, maybe the commentary or the signs. Where is it that you are the most bullish on? Which names?
I would tend to think would be some of the home and personal care names. I mean, clearly the sector like leader, Hindustan Unilever, we think we would be very positive on at this juncture, and we think that it should probably one of the best businesses, given the current environment and the uncertainty that is there. I think their ability to manage it would probably be, will definitely stand out. And I think some of the more bottom-up stories we liked in the home and personal care space, both from a quarterly perspective as well as an outlook perspective, would be names like, say, Godrej Consumer, names like Marico, and maybe even Dabur, where there is clearly tailwinds in parts of their businesses given the current environment. Discretionary has been a little bit of a mixed bag. If you ask me, I think they've not. I think business remains under pressure. I think maybe except, say, the paint space, like you mentioned in your earlier question, where I think we've been positively surprised at what's happening. I guess what's happening is anything that's got to do with in-home, people are still sort of consuming, or demand has been relatively okay compared to, say, jewelry or apparel, for that matter. But I think there's no specific name that stands out, frankly, because I think a lot of those stocks have run up quite a bit, and we're on the sidelines on most of the names there.
I can imagine the valuations are indeed sky high. Thanks for that, Aditya. Manish, I didn't even get a chance to ask you about NBFCs, but I'll ask to club into one. I mean, based on whatever you've seen and what you expect to come out because of the asset quality issues, moratoriums, so on and so forth, and the books, where is the commentary and your positive bias aligned?
Sure. So going into the result season, our view was that one needs to stick to the larger banks and larger NBFCs only, and not really go lower down the curve. But given the way, let's say, the deposit growth has played out of many of the mid-sized banks, or the capital raise which have since been happening at banks and NBFCs as well, now we think while our preference still remains for the larger banks, it's selectively time to add some of the mid-sized names as well. But we would still prefer mid-sized banks over mid-sized NBFCs, given that some of the NBFCs still have that liability issues to be sorted out. But from a position where the focus was exclusively on the larger entities only, given where the valuations are and the fact that some of the mid-sized banks have raised capital and deposits as well, I think it's selectively time to start adding some of those mid-sized names. The other key variable from a sector perspective is the consumption trends around the festive season. While there will be a lot of noise around moratorium, restructuring, and so on, given where the valuations are, if consumption picks up towards the festive season, for example, auto sales, right, then where the valuations are for these mid-sized banks or in mid-sized NBFCs, we could see a good amount of interest coming back in those names.
Okay, so we'll watch out for all of those. Surendra, one final question. We didn't talk about TMT, or rather we spoke about technology, but not media and telecom. I can't end this conversation in a very quick word about how do you expect telecom to be? We're on the cusp of maybe a historic decision as well. How do you expect telecom to shape up?
I think in telecom, obviously, as you pointed out, this decision is quite important. But our view for some time has been that it's a sector where we have seen meaningful consolidation. And if you see the market share trends, the consolidation is very visible, even over the past few months. And which is why we have been kind of overweight on one of the stocks, which we think ends up benefiting, irrespective of how the consolidation plays out. So obviously this outcome will be keenly watched, but directionally, I would still think that it's a sector where, because of consolidation, there will be more pricing power than we have had in the last decade. And the usage will only go up, given the kind of trends that we are all in. So given that backdrop, we are positive on telecom, but again, overweight on a specific stock.
Yeah, we've just contributed to 2.5 hours of data usage between the 5 of us as well. But gentlemen, really appreciate you taking this time in these difficult times, I must add, to join us today and speak to us. Thank you so much. Really appreciate your time, and stay safe.
Thank you.
Thank you.
Thank you so
Thank
much.
you. Likewise.
Thank you.
Bye.
Bye-bye.